You've probably seen headlines floating around about a 50-year mortgage, and in this video, I'm going to break down my personal thoughts of whether this is good, bad, or indifferent, and just kind of breaking down what we know so far about it. And if you're new to the channel, my name is Christian Stubbs. I'm a team leader and owner of Onyx Homes. We have helped almost 1,000 people move all over Southern California just since year 2020. Now, I make these videos in this channel all about Orange County just so that we can help you make your next move a little bit easier so you can make better decisions. So I'm going to give you my perspective as a professional real estate agent that knows a lot about the market. So a 50-year mortgage might be coming. There's a couple different things that I think are really important. So let's first kind of zoom out and just look at overall mortgages in general. So the gold standard in the mortgage space right now is a 30-year fixed rate mortgage. But there's also a 15-year fixed rate mortgage option also. That is a very popular option for people that can afford to have a higher payment. Now that we're bringing in another option, which there are more than just these options, but these are the gold standards, they're talking about a 50-year mortgage. So first of all, this is not out already, at least at the time that I'm filming this. This is not anything to wait for either. There is a lot that would have to happen for this to actually go through and for these loans to start actually happening. My projection, I'm filming this in November of 2025. It's going to be at least 6 months to probably 2 years before we actually see this. But here's what would happen is if you just look at what we have right now, the 30-year fixed and a 15-year fixed mortgage. The 30-year fixed mortgage is what most people do. Some people choose to do a 15-year mortgage because it's one, you pay the mortgage off much faster, which means you pay way less interest. It's half the amount of time of the loan. So you're going to pay way less interest. Also, because the loan is shorter, the bank takes on less risk. So because there's less risk, the mortgage rate, or the interest rate rather, is lower on a 15-year than it would be on a 30. And taking that same logic, if there's a 50-year mortgage, it is a longer loan. So the interest rate on a 50-year will likely be higher than it will on a 30 and certainly than on a 15. Also, you're adding 20 years of additional loan payback, which is going to add a tremendous amount of interest. Now, when we look at the math on this, the mortgage payment difference between a 30-year and a 50-year is really not that much. It's about a 10% decrease. So if you had a $5,000 mortgage payment on a 30-year, it's probably only going to be 10% less, or $4,500 on a 50-year. So 20 extra years of payback for $500 a month. Does that actually make sense? That's obviously up to you, and you're going to need to talk to a lender to really get more information about this. But if we look at this, here's what I think this actually does. I think this gets a lot of news headlines to get people interested in, like, can I actually afford to buy a home? And as a professional real estate agent helping tons and tons of people buy their first home, most people have no idea that they can afford to buy a home right now. They think they need to save 20%. They don't. They think PMI is a bad thing. It's not. It's just an extra cost. And the hardest house to buy is your first one. So I think this is going to be an awesome opportunity because it's going to make more people aware that owning real estate is an option. A lot of people think it's just, oh, it's so expensive, it's not affordable. You just need to figure out what you can actually afford. Now, if your goal for looking into this 50-year mortgage is to save, or rather to help your affordability, to save some mortgage payment, I've got two incredible options that we have clients right now taking advantage of. Number one, seller credits. So the whole idea behind saving, let's say that $500 a month with this 50-year mortgage option is if we're trying to save $500, there's more than one way to save $500, and a 50-year mortgage is a potential option in the future. But right now, we have clients all the time. I personally just did this on a investment purchase that I just made, is you can do what is called a temporary or a permanent buy down. Let me explain. A temporary buy down is where you can do a 2-1 or a 1-0. Now, what this means is you can ask the seller to pay a credit towards your closing cost that will buy down the interest rate. So let's say, for example, your interest rate is 6% for the normal loan. If you do a 2-1 buy down for the first year, your interest rate is 2% less. So 6 minus 2 is 4. So for the first year, your payment would be based on a 4% interest rate. And then the next year, it would go 1% less. So instead of 6, it would be 5. And then forever on after that, it would go back to the normal 6. This would save you likely more than the $500 per month, and it's on a 30-year loan. So you would pay way, way, way less interest and still save that money on your payment. Now, that's your temporary buy down. There's several different options. The 2-1 and the 1-0 are the most popular. The other option is to do a permanent buy down. So maybe you get the seller to pay towards your closing costs, and that can permanently buy down your mortgage rate. So instead of a 6% rate, maybe for the entire life of the loan, you can get it down to 5.5%, and that will save you money on your mortgage payment, and it's going to affect the entire life of the loan. That is one thing we have a lot of our clients taking advantage of right now. Now, the second thing you could do, and this doesn't necessarily make your payment more affordable, but there are lower down payment options. So this will likely make your payment more expensive, but the house might be more affordable, right? Your payment and the actual what you can afford for house price is different, because a lot of people get stuck on I have to have 20% down, and they look at a much lower priced home because they think they have to have this 20% down. When the reality is so many of our clients are putting somewhere between 5 and 10% down. Probably the most popular actual loan option is 5% down. It's what I personally did when I bought my first condo. And what ends up happening is you can buy that home faster. Now, yes, you're going to have mortgage insurance, and yes, your interest rate might be slightly higher, and yes, your payment will be slightly higher. But the difference on just the cash in pocket, let's say you do have 20% down and you're just scraping by to get to that 20%. Well, you might do a 10% down option. Your payment might be a few $100s higher, and you might have a little bit of mortgage insurance, so maybe $500 or $600 total more, but you have 10% extra cash in your pocket. For some people, that's way more valuable. Now, here's the other reality is we hear a lot of people who are saying, oh, you know what, Christian, I want to save to have 20% down before I buy. Here's the story. I have a very good friend who has been saving to put 20% down for the last 6 years. He could have bought a home 6 years ago, and had he done that, he would have probably bought a home for $300,000 to $400,000 6 years ago, which would have been a 2 or 3 bedroom condo in the area that he lives in. And had he owned that house for the last 6 years, it would probably have doubled in value very realistically over these particular last 6 years. And he would have hundreds and hundreds and hundreds of thousands of dollars in equity in the home, and he would have had tax write-offs, and he would have had all the benefits of being a homeowner over these last 6 years. Now, I will say we have had exceptional appreciation over the last 6 years, but even if we just had the normal 5% every single year, he would have hundreds of thousands of dollars in equity in the house. Instead, he has been renting for the last 6 years. Let's just say he's paying $40,000 a year in rent. So $40,000 times 6, assuming his rent didn't go up, which we all know it did. 40,000 times 6, I'm not doing public math, it's like a lot of money. That was for sure thrown away. So he took 6 years to save up the money for 20% down. Prices have since pretty much doubled since then. He missed out on hundreds of thousands of dollars in equity. That's the reason why the $200 or $300 a month on private mortgage insurance or PMI is not a bad thing, because you get in earlier. And again, with buying real estate, buying the first one is the hardest. If you can get into your first condo, townhome, whatever it might be, single family home, doesn't matter. You get into the first one, you start building more equity, prices appreciate, you get all the tax benefits. No, I'm not an accountant, but talk to your accountant. There should be tax benefits. I'm not a CPA. Once you live in that house for 3 to 5 years, you will have likely built up equity. It likely would have appreciated. Maybe you do some forced appreciation, and then you can sell that home and roll the equity into the next one. Or, God forbid, you keep that property and then you buy the next one independently, and now you have an investment property or a second home or whatever it might be. This is the thing that I don't hear nearly enough people talking about, is finding a way to get into your first property if home ownership is important to you. If it's not, then I don't know what you're watching this for. But if it is, getting into that first one's incredibly important. Or if you own one and you're looking to up leg into your next property and you want to keep this one, don't feel guilty for not putting 20% down. A lot of people guilt trip for like, oh, you're paying mortgage insurance, or you're lighting $300 a month on fire. It's like, who cares? You spend $300 on Starbucks every month, or whatever, on In-N-Out. Buying real estate is a gateway to wealth for a lot of people. It's not for everybody, to be clear. So anyway, let's recap. 50-year mortgage, I think it's good in the sense that it's going to bring more people into the housing market. It's the most sure way to build wealth over a long period of time. It's not going to be happening anytime soon, but I think the headlines will help make more people aware of the fact that they could and should be buying real estate. It is going to be way more in interest. The 30-year, I think, will always be the gold standard, or I shouldn't say always, but like it is going to be the gold standard. Higher loan amount, just higher interest rates. I don't think it's a fantastic idea. I think you can accomplish the same goal by doing temporary or permanent buy downs on your mortgage rate. And if you want more information on this, I know we're going a little bit more detailed, tactical. You can always reach out to us. We'd be happy to help you out. Now, if you want our entire home buyer negotiation blueprint, I typed this thing up. Originally, it was 126 pages. My marketing manager yelled at me and I condensed it down to 13 pages, maybe 12. And this has all the tactics that we use, or at least most of the most important ones. If you want the full thing, after you download, the link is in the description below. After you download this, on the next page, you can book a call with our team. If you do that, we'll walk you through our strategy session where we talk about all the things that are going to help you take advantage of the market, stay protected, and get the best deal possible. So if you want to do that, link in the description below. In the meantime, I made this next video that I think you're also going to like as well too.